Hey there, and welcome to my channel, The Paper Bag Investor. Today's video is really for Canadians. I'm a Canadian, so this video is for Canadians, and I'm going to be talking about what kind of investments can you put in a tax-free savings account, a Tfsa. This actually comes from one of my previous Tfsa videos, a comment by a user named Siamese Lim. He asked, what kind of investments can you put in a Tfsa? Could you explain this? I just want to say thank you for anyone who comments on my videos. If there's any questions from this video as you're watching, let me know in the comments down below. Before we go any further, I just want to make it absolutely clear, I'm not a personal financial advisor. I'm just a guy with a paper bag on his head, a Canadian guy who loves investing and thinking about the future. And if you love investing, you love thinking about the future, you want to do better with your finances, I encourage you, especially if you're Canadian, I encourage you to hit that subscribe button down below. Follow along with my channel as it grows and become a better investor with me. I'm really big on Tfsas as Canadians. I think it's an amazing investment vehicle. I've done a number of videos on Tfsas, even how to open a Tfsa account with Questrade. I'm going to put all those links in the description of this video for you guys. There's also a playlist on my channel that has all those videos queued up. Also, if you're wondering, why the heck do I have a paper bag on my head anyways? I'm going to put a link to a video where I explain some of that as well. So this video again is on what kind of investments can you put in a tax-free savings account. It's kind of a beginner video, but please stick around to the end of the video. I'm going to be explaining what I think is the best kind of investment to make in a tax-free savings account, giving you my thoughts and perspective on that. So please stick around to the end for that. But first off, you can put cash in a tax-free savings account. A lot of banks offer kind of a true savings account, tax-free savings account, where they might offer you very low interest rate, and you could just put cash in there, sit there, and generate this very low interest rate. So that's number one, you could put cash. Number two, in your tax-free savings account, you could buy a guaranteed investment certificate, or known as a GIC. And basically a GIC, the gist of it is you agree to lend the bank or financial institution your money for a set amount of time, and then you are guaranteed to get the amount you deposited back at the end of the term. Okay, and a little more details on this, a few key points. It's one of the sort of quote-unquote safest ways to invest your money. There's typically no fees associated with it, and typically it's a fixed interest rate, a set interest rate. It could be variable, but typically they're a fixed interest rate over the term, and the money is protected by Canada Deposit Insurance Corporation, and basically they're a federal government crown corporation. So your money is essentially kind of backed by the government. You're lending the money to the government. They're paying you a set interest rate over the span of time. You get those payouts every 3 months, 6 months, just be in the terms. And then at the end of it, you should get exactly the amount you deposited back. So that's a GIC in a nutshell. The next one is, what is a bond? We're going to look at bonds. It's kind of similar to a GIC. When you buy a bond, you're lending money to a company or a government, the bond issuer, and for a set amount of time. It could be a year, could be even up to 30 years. And then in return, the issuer pays you interest. On the date the bond becomes due, the issuer is supposed to pay back the then face value of the bond to you in full. So this is a little bit different because the face value of a bond could fluctuate or change over time versus a GIC, where you just get exactly the amount you deposited back. A bond could be worth more or less. It's basically that agreement for the bond could be worth more or worth less depending on interest rates and at the time. So a little bit more about bonds. The face value, as I said, could be higher or lower than what you paid for the bond. You can make money on a bond from interest payments and by selling it for more than you paid, of course. Or you could lose money on a bond if you sell it for less than you paid, or the issuer defaults on their payments. So because it is, a GIC is completely backed by the government, it's very safe investment, because unless the government's going to default somehow, the bond can be backed by the government, but also can be backed by a different company that needs to raise money. And you're not buying equity or a stake or ownership in the company, but when you're buying a bond, you're basically just making them a loan. And then that loan that contract of that loan is itself worth something, and could be worth more or could be worth less over time. And of course, the contract of that loan that you're creating should generate you interest based on the terms of the bond. And of course, if the company you've loaned to somehow goes belly up, you could lose your money if they squander your money and they can't repay their loan. So there's some risk there. Next one, what is a mutual fund? Okay, so a mutual fund is pretty simple. It's a collection of investments such as stocks, bonds, or other funds owned by a group of investors and managed by a professional money manager. And they typically just take a fee of, maybe it's 1% or 1.5% of the equity you have. So if you have $100,000 in there and it's 1.5%, you made $1,500 a year of that $100,000. They just take as their own, management fee. Mutual funds, a little bit more detail on them. They can focus again on specific types of investments. For example, invest mainly in government bonds, stocks from larger companies or from certain countries, or it may invest in a variety of investments. So it can really focus on something, or they can, and that should be clear when you're buying the mutual fund, kind of what their strategy or sales pitch to you is. Okay, what is a stock? Okay, so a stock, finally, you can also own a stock in your TFSA. What is a stock? Stock means you own a portion of a publicly traded company. You can buy or sell these shares or stock of the company, and when you're owning stocks, you're owning actual equity and ownership of a company. You have the highest possible rewards, but also the highest possible risk, because if the stock goes bankrupt, the company goes bankrupt, you could lose all your money in your investment, of course. If a stock does go bankrupt, and they still have assets that are available, the people that are lenders to that company, the big people that bought bonds to that company, banks that have made loans to that company, that don't own the company but have loans, they're going to get first dibs on those assets and maybe able to retrieve some of that money. But if you're just the owner of the company, it's literally like you starting a company, owning shares of the company. If it goes belly up, it goes bankrupt, you'll lose your investment for sure. But okay, so those are a few of the things you can put in a tax-free savings account. What do I think is best? The next question is, what do I think is best? I think it's stocks. I think it's owning equity and ownership of a company. This is really the strategy I take, and it could be seen as more risky, more volatile, but I like owning a company, and I actually think about my investing in that way, that I'm actually owning a piece of this company that I'm buying when I'm buying shares of a company, and that company can somehow produce value over time. And it can actually grow and rapidly at an exponential rate produce even more value over time to the public, to consumers at large, and of course to the shareholders, the people that actually own the company. There's certainly, maybe some people would see that as more risky, taking ownership stakes in a company, but I really see, as opposed to, say, owning a mutual fund where you have a whole slew of companies, you're paying an investment manager 1.5%, 1%, something in that ballpark, just to manage your funds, no matter what their performance is. It's hard for me to really analyze and have a high conviction rate that, yes, this is the mutual fund that I want to buy. But when I look at individual companies, I can see the CEO and the CFO and really listen to the interviews of them talking about their product, talking about their company, talking about their strategy, and see how clearly their thinking is. You can look at their product and say, this is why people love their product or why they don't love their product. You can see the market as a whole in the world and technological shifts happening that could directly affect that company and the market they're serving. And so you can really drill down and analyze a company as an actual thing, and then decide, is that something I want to own or not? And if you find those right investments, you can do phenomenally well, 10x your investments, even 100x your investments over time with certain companies. And so that's why I love buying stocks the most, especially in my TFSA, because the beauty of a TFSA TFSA is that as the money grows and compounds inside of a tax-free savings account, you don't pay any tax on that money that's in there, but also on the money that's earned that's in there that keeps snowballing and growing. So even if your TFSA grows to $100,000 or $500,000 or $1 million or $10 million, unless the government cracks down on TFSAs or changes regulations or laws around them, but for now, you can keep snowballing that into a huge tax-free savings, tax-free account. And if you're just putting it into something very, very sort of safe, like a GIC, where you may not even beat inflation with a GIC, which could mean your asset is losing money over time just by sitting there. But you're not going to get those, or say it even just slightly beats inflation and you make a tiny little profit over time in a GIC, you're not going to have, there's not much point in really sitting there in a tax-free savings account, because you're not going to compound any sort of huge rate over time. So you're not going to have these huge tax savings over time in this very large tax-free account. So that's why, stocks to me are the very, very best. If you got any value out of this video, I encourage you, hit the subscribe button down below. This channel, I'm going to be talking more about things related or specific to Canadians, tax-free savings accounts for sure, because I love them so much. But also I'm going to be talking about companies that I'm buying that I see have great, great potential now and going forward. And that's what this channel is really about, is my research, presenting that to you guys, getting feedback from you guys, trying to make you become a better investor by seeing what I'm buying, what I'm researching, and help us all do better with our investments. So again, if you like this video, hit the subscribe button, hit the thumbs up. It helps the YouTube algorithm, helps me grow. Leave a comment down below in the description or in the comment section there, and tell me what you think. Let me know if you have any other questions or thoughts for future videos. Okay, thank you so much for watching. I'll see you in the next video. Peace.